Okay. Uh, Tonight's actually going to be one of our most exciting nights of the season so far. First week, we kind of give you a couple of items to walk through, talk about decision-making process, going through trees to determine filing status, dependency, that type of thing. Last week, we talked about income, how that would actually be reported on income tax returns using certain forms and where that would go within tax layer. Tonight, we're actually going to talk about how we actually start taking adjustments to income and credit. So we're actually going to start taking money away from the government tonight, which is one of the main reasons why people are coming in to get their taxes filed, the opportunity for them to receive a refund. So one of the things we want to start off with is the ability for taxpayers to go ahead and take certain deductions or expenses on their return. Now, last year we had a major shift in our tax laws where the majority of taxpayers, particularly coming into VITA, will no longer file itemized deductions. Most of our taxpayers will take a standard deduction because they're so much higher than they have been in the past. However, we still have the ability for taxpayers to take certain what we call adjustments to income. These are going to be deductions that they're able to take on the return, even if they take a standard deduction. So it's going to be eligible for certain taxpayers, and we'll go through a couple of the rules here. These are all going to be reported on the Form 1040, Schedule 1. And there are a number that were going to be within scope for our basic certification. That includes a qualified educator expense, which we'll talk about in just a minute. There's also a penalty on early withdrawal for CDs or savings accounts. That one will automatically populate once you enter the 1099 INT from last week. So if you have an amount entered in on early distribution from a early withdrawal penalty from a savings account, that will automatically flow to the Schedule 1. Also alimony paid, and we'll talk a little bit more about that, in addition to IRA contributions and student loan interest deductions. So the first one I want to mention is educator expenses, and a lot more detail on this deduction will be found on E3 of your 4012. For qualified eligible educators, they can actually deduct up to $250 on their income tax return for expenses made during the tax year. And these are going to be the lesser of the actual amount of expenses incurred, or $250. So if you have an educator, and you'll see this by the occupation on the intake sheet, you just want to simply ask how much do they have in qualified education expenses, even if they say, well, I can take up to $250. Yeah, the question is, how much do you actually have in qualified educator expenses? So if they say I have more than 250, we can take the maximum. If they say I have 180, we can take the 180, not the 200. So the next question is, in the fun world of IRS definition, what do they mean by educator? And an educator is anyone who's actually working in grades K through 12 for 900 hours a year as a teacher, instructor, aide, counselor, or principal. So homeschool do not count. So if you teach your children at home, you do not get a $250 deduction for materials. But this would be people within the K through 12 program and fits a very broad variety of individuals. Now, what do we mean by qualifying expenses? And these can be a variety of items. These can be things like books, supplies, classroom material. They can be other types of educational material, including computer software, computer hardware as well. Or any other material, so bulletin boards, pens, papers, markers, whatever the case may be. If they have to buy their own supplies, they can be deducted on the return. Likewise, if they're taking additional education courses. Now, we just have to bear in mind, if the educator is being reimbursed by the school district for these costs, they don't count. But if they're paying out of pocket for these expenses, then they do qualify as eligible expenses. So again, professional development would qualify if they have to take any additional training or courses that are not covered by the school itself. For one odd reason, apparently Congress does not appreciate gym or health class, because the only educators that do not take benefit of this deduction are those that are health or physical education instructors. So they are not allowed to take this deduction for non-athletic supplies used in the classroom. So if you know anyone who's a health or PE teacher, be sure if they have a future congressman or senator on their hands that they're nice to them in class. But unfortunately, this level of educator is not eligible for the deduction. But pretty much everyone else within that school would be for K through 12. One other item that we've talked about a little bit when it came to income is the question of alimony. And alimony would be taxable income, and also equates to a tax deduction by the person who pays the alimony. This is for any divorces that are entered into prior to 2019. So the divorce had to be finalized by December 31st, 2018 in order for these rules to apply. Basically what we'd be looking at is, in most cases, if the person is just divorced in the current year, we don't need to worry about alimony. So if they have a divorce that was completed here in 2019, there is no income that needs to be reported and no deduction to be taken. So the main area we have you take a look at is, what does a prior year return show? Did they have alimony paid and alimony received in a prior year? If so, we may want to question whether or not that continues. But the rules for alimony are kind of unique, and they have to actually qualify for all of the following in order for them to be considered alimony. So the first main issue we take a look at is payments are required by a divorce or separate maintenance agreement. The next one's kind of interesting. The payor and recipient spouse cannot live together and file a married filing joint return. We'll let that one sink in for a second. This is a divorce agreement. If you decide that you no longer want to be divorced and you're now going to be married again and filing jointly, one of them cannot take a deduction and the other one have income on the return. Sounds like a fairly basic rule, but apparently the IRS wanted to be sure that you're all aware that you cannot file jointly with your ex-spouse and still take an alimony deduction. The payment has to be in cash or cash equivalents. Also, for those of you who enjoy the English language, I apologize. This next definition will contain a double negative. So alimony cannot be designated as not alimony. So if we cross off those nots, it's basically saying that we intend for these payments to be alimony. It's really kind of a legal way to say, if the agreement says these payments are not alimony, then we honor that agreement and say, yes, we're going to treat them as not alimony. So then that's where the double negative comes in. The agreement cannot state that it's not alimony. It doesn't have to clearly state it is alimony, but it cannot state that it's not alimony. Just to throw more confusion out there, again, these do not occur for any divorces in the current year. They're only going to be for divorces prior to 12/31/18. The spouses have to be living separately. They have to be legally separated. They cannot be living together and maintain the same household in order for alimony to be considered deductible. Payments also have to cease upon the death of the recipient spouse, and we have to just make sure that they're not child support. So typically in a divorce situation with minor children, there may be a payment that's for alimony and part for child support. The child support portion is not considered a deduction for alimony. So again, these are going to be deducted by the person making the alimony payments, and the person who is receiving should be reporting these on their income tax return. We'll take a little bit of a look here. The IRS is very good at matching things up. So if one person's deducting it, they're going to be expecting alimony to be reported as income on the recipient spouse. And we'll also do a little foreshadowing because the government's going to go and show another matching program a little bit later. Oh, and we'll hold questions until the break of this. All right. So what we're going to take a look at next is IRA contribution. So IRA contributions, a little bit more information on your E9 of your 4012. So on IRA contribution would be if an individual comes into VITA and they would like to make a retirement contribution, be able to put some additional monies away for their own retirement benefit. And this is possible as long as they're under the age of 70 and a half, and they may contribute to an IRA and receive a tax deduction. Now, the rules for the contribution would be that they have to be made by April 15th of the year, unless the income tax return is extended. And generally, we do not extend income tax returns within the VITA program. So we're trying to get them to file by April 15. The nice part is these contribution limits have increased from the prior year. They're now up to $6,000 per individual. They're up to $7,000 or an additional $1,000 if the taxpayer has reached age 50. However, we just need to be aware if the individual or their spouse had participated in a retirement plan by their employer, they may be limited or denied the opportunity for deduction for the IRA. And so your next question may be, well, how do I know if they're a participant in a retirement sponsored plan? And the easy answer is it's on the W-2. So if you take a look at the W-2 when you're entering the wage information, box 13 will have a checkbox to say whether or not that they were a participant in a retirement plan. Now, one thing you may have to just be aware, that box will indicate whether or not they're participating, and that will also help trigger the calculation. One thing we do want to mention, if they still want to contribute to an IRA, but they cannot get a deduction. If you recall from last week, we had talked about the problems with the 1099-R, having some partly non-taxable distributions. we would probably recommend that if possible, they can make that into a Roth IRA contribution, not a regular IRA non-deductible contribution. That will actually separate that into a separate plan. It makes it a whole lot easier on the back end to calculate any tax liability. We don't see this all that often within VITA, that individuals want a Roth contribution. However, it may come into play when we talk about the Affordable Care Act next week and one of our after tax year strategies to reduce taxable income. One other deduction that we may see that's a little bit more popular is actually our student loan interest deduction. This is found on E10 of your 4012. What this would be for any interest paid on a qualified student loan. Most likely how this will be determined by our greeters, our taxpayers, is that they will actually be receiving a Form 1098E, which will be indicating it's a qualified student loan interest payment. These loans could be for the taxpayer, it can be for their spouse, or it could be a dependent of the taxpayer spouse at the time of the loan. The loans have to be repaid within a reasonable amount of time after the loan was taken out. For those of you who have not been around education loans, they will start taking those out as soon as possible. So it's a relatively reasonable period of time that they start taking those out. As long as the loan was taken out for qualified education purposes for an eligible student, meaning at least half time at an accredited institution, the loan will be considered a qualified loan and the interest may be deductible. The nice part within VITA, even though that there are AGI limitations, the clientele coming into VITA will be all falling underneath the AGI limitations. If you're doing returns for friends and family and you're wondering why your student loan interest may be limited or non-existent, we have relatively low adjusted gross income phase outs for student loan interest deduction. So if you're a physician making $500,000 a year, you do not get a deduction for your student loan interest. If you're a working individual who makes $45,000 a year, you do have the opportunity for deduction for student loan. And the deduction is going to be the lower of either the actual amount of interest paid, and this could be for the taxpayer or the spouse, or $2,500. So the combined amount of student loan interest or $2,500, whichever is lower, would be the amount of deduction. A couple things that you'll probably hear about tonight. One area that we do want to watch, if you're married filing separately, you may not take a student loan interest deduction. You'll probably hear this a couple other times in this presentation. The one other thing you have to take a look at is you may not be dependent on someone else's return. So sometimes you may have a situation where the student is paying the loan while they're still a dependent on their parents' return. They are not eligible to take a student loan interest deduction at that point in time. One other thing to watch is that you must be legally obligated to repay the loan in order to take a deduction. We may have a situation where someone comes in and says, I have a grandchild who I'd like to make sure that their student debt's being paid timely, and I'd like to go ahead and help them out, and I'll pay the student loan on their behalf. That's great. That's wonderful. Highly encouraged. But the grandparent cannot take the student loan interest deduction. They're not legally obligated to repay the loan. However, the deduction's not lost. If the student files a return, they may actually take a claim for the interest paid by their grandparent. So whoever pays the loan, we have to take a look and see whether or not they're legally obligated to pay. And generally, the 1098E will indicate if they are a legally obligated individual. If not, we just have to ask to make sure that they are required either as a co-signer or guarantor of the loan to make payments. As long as the loan was used for any type of educational purpose, this can be tuition, qualified fees, any related items, which includes room and board, and any books, anything else, we can actually treat this as a qualified loan payment. Again, probably the easiest way to think of these, a 1098E will come in. As long as the taxpayer is legally obligated to repay the loan, we can enter the information in TaxSlayer, and generally no AGI limitation will apply. So those were pretty nice. Those are our adjustments to income. Those allow us to reduce our taxable income dollar for dollar. So we can actually reduce our taxable income, bring our adjusted gross income down, and pay a little less in tax. The next area we're going to get into is what we call credits. And if we thought the adjustments were nice, these are even nicer. Credits are going to reduce our tax liability dollar for dollar. So it's not just reducing taxable income. These are actually reducing any taxes we owe dollar for dollar. We're going to start off by talking about our common non-refundable credits. These are going to be found on Schedule 3 of the Form 1040. The first one we're going to talk about is the foreign tax credit. We do mention the Form 1116. We will not be filing the 1116. It's a relatively complex form, but we do have the option to be able to take foreign tax credit for taxpayers without filing this form. So if they meet the following conditions, If their foreign tax withheld or paid is $300 or less, or if they're married filing jointly, it'd be $600 or less, and that foreign tax is reported on either a 1099 INT, 1099 DIV, or Schedule K1, we can actually file the foreign tax credit without needing an 1116. So this will automatically just populate on line 1 of the Schedule 3, and we're going to make that election to go ahead and do that to take the foreign tax credit. Where we may see this, generally not on interest at all, but sometimes a dividend may be held in a foreign country. Sometimes people who may have a mutual fund that has international securities may be paying some taxes in foreign countries. Generally a very minimal amount, a couple dollars, but whatever tax they pay in that foreign country can be used as a non-refundable credit against their US income tax liability. Now, a couple of the other ones we'll be talking about are going to be our credit for child independent care, education credits, and our retire savers contribution credit. So the first one we want to take a look at is our credit for child independent care. The nice part about this credit is that there is no absolute AGI phase out. So people of any gross income, even if you have Bill Gates money, can take up to 20% of the child care costs as a credit. A little bit more information on G10 of your 4012. So if you have one child, you can have, or one qualifying individual, you can take $3,000 worth of qualifying expenses. If you have more than one child, you can go up to $6,000 for qualifying expenses. The credit will range from 35%, almost about 1/3 of the cost, up down to 20% on a sliding scale based on your adjusted gross income. One thing we do want to have you take a look at when you enter the W-2 information. Taxpayers may have participated in a plan at work where they can actually have pre-tax dollars used for qualified care expenses. That would be shown in box 10 of the W-2. So if you take a look at the W-2 and you enter all the information as you see it, it will probably prompt you that 2441 would be required for the return, meaning that they are having pre-tax dollars used for qualifying care expenses. So those would be, unfortunately, the $3,000 would need to be reduced by any amount in box 10. Now the eligibility rules. So the first thing we take a look at, we start with child independent care. So the nice part is it starts off with the definition of child. Now, I'm going to warn you, the IRS definition of child continues to change as we go through the entire course here. So it's slightly different from where we talked about from a dependent situation. In this case, the IRS considers a child as someone under the age of 13. So they have to be a custodial child of the taxpayer. So we talked a little bit about a non-custodial parent may take a dependency exemption if the custodial parent waives their ability to claim the child. In this case, only the custodial parent can take the child for child care credit. So even if you have a taxpayer that says it's not my year to take the child, I granted opportunity for my ex-spouse to take them, they're the only ones, the custodial parent, who can take the child care credit. So the IRS has determined that anyone under the age of 13 is incapable of caring for themselves. As soon as you become a teenager, you are welcome to watch yourself at any point in time without adult supervision. I know most teenagers probably feel that they can do this, and apparently the IRS is agreeing with them that they do not need care. But what we're looking at here is the opportunity for generally care for individuals while a taxpayer is working. That was the original intent of the child independent care credit. However, these do not need to be simultaneous. So as long as the taxpayers have earned income, and if you're married filing jointly, both taxpayers have to have earned income, you may still take the child independent care credit. One unique factor is that in addition to kind of your traditional before or after school programs that may be hosted by either a school, a community organization, a local church, this also includes babysitters, child caregivers, and summer camps, as long as the summer camp is not an overnight camp. So you may send your child off to soccer camp, Star Wars camp, Legos camp, any type of camp that you want, as long as it's not an overnight camp. So as long as they're not caring for the child overnight, all those camp expenses do qualify. One of the other wrinkles we have here, though, before we get overly excited and say, great, now we can start, when we drop them off at the grandparents' house while we want an evening out, we can start taking those as expenses if we happen to pay them. You can. The only thing you need is the taxpayer willing to give you their Social Security or employer identification number. So in order to take the child or dependent care credit expenses, we need to know the name, the address, and the tax identification number of the person providing care. If you recall, we talked a little bit about that matching program with Alimony. The IRS is much better at this matching program because what they're going to do, they're going to match the Social Security or EIN that the taxpayer indicates on the 2441 and look for that individual or entity to report child care income on their return. So it may happen that you have a client who says, I have a neighbor down the street who watches my child for me while I'm working, and they watch them until 5 o'clock at night till I'm home from work. And you say, well, it sounds like you could be a candidate for the child independent care credit. How much do you pay? Well, I pay $3,000 a year. Great, all we need is their social security number and their address. Therein lies the problem. That's fine. We don't need to go ahead and go any further with that, but we cannot take the child independent care credit. So we do need the social security number and employer identification number. In addition to children, you may also take the dependent care credit for any dependents of the taxpayer who need care because they cannot take care of themselves, either from mental or physically incapable of taking care of themselves. So that could include things like bathing, feeding, medication. If they require care and they live in the taxpayer's home for at least half the year, they would also qualify for the dependent care credit. Likewise, if the taxpayer's spouse also would need care because they're physically or mentally incapable of caring for themselves, you can also take the dependent care credit for that individual. Obviously, if they cannot take care of themselves, you do not need to have earned income for the spouse who cannot care for themselves. So basically what we'll take a look at is this information. We'll get this from the taxpayer. They will let us know the amount of care. The form 2441 will walk you through the process. If it's your first time doing it, it just takes a little bit of work to get through. We have to enter the total amount of care expenses in step 1. Step 2 will make you reconcile that with the individuals eligible for the care. Now, just one thing as we talk about that child under the age of 13. So once they turn that magic 13 years old and become a full teenager who can certainly cook, clean, and take care of everything they need to do on their own, you may not take expenses after they turn 13. So if the child's birthday is October 1st of 2019, you cannot take any expenses from October 1 through the end of the year. However, if they were in an after-school program or care or summer camp from January 1 through September 30, those expenses still qualify. So you may still take that during the year, but once they reach 13, those expenses no longer qualify. But just want to clarify that for the dependent care credit. All right, heading into one of our more exciting credits that we have for purposes of non-refundables. Taking a look at education credits. This is actually on J6. We actually have an entire tab in your 4012 dedicated to education credits. And what we're going to take a look at is our education credits on the J5, which will be giving you a bit of a rundown between the 2 available credits that we have within the VITA program. The first one's going to be the American Opportunity Credit. This one's the more powerful of the 2, and we'll show you some differentiation on the next slide. The second is the Lifetime Learning, which would apply for individuals who do not qualify for the American Opportunity Credit. So in order of priority, we always try and go the American Opportunity Credit first if they qualify, and then to the Lifetime Learning. So credit eligibility for both of these is we'd be looking at the taxpayer, the spouse, any dependents who are claimed on the return who are attending an eligible post-secondary educational institution. In most cases, the way that you're going to get the information is by receiving a form 1098-T from the institution. So that's going to indicate that the institution is qualified. If there's any questions, we can use the Department of Education website. In most cases, if it has college or university next to the name, it's probably a qualified institution, as long as they can accept student loans. If it's Bud School of Surfing in California, it's probably not a degreed program, unless they actually have a 4-year program to get a bachelor's in surfing, which I'm pretty sure they do not, and certainly not a postgraduate doctoral program in surfing. But if they have a 1098-T from a college or university, it generally would be considered a qualified institution. The individual claiming the credit cannot be claimed as a dependent on someone else's return. So this may be an issue as you have students who are actually filing returns. They may try and take a credit for themselves. If they are still being claimed as a dependent on their parent's return, they may not claim the credit. So if they're claimed on their parent's return, only the parent can claim the credit. One of the issues we run into here as well, Within VITA, we're not going to run into the AGI phase outs, but again, these phase outs are relatively low in terms of credit eligibility. But if the parent is claiming the child, then the parent's the one who can claim the education credit. Probably no surprise in the next one, you cannot file married filing separately. So we may have mentioned that already, and I'll probably hear it a couple more times tonight. This whole evening doesn't apply for the most part if you want to file separately. So try and convince as best possible our clients to take a look and see what ramifications there are for filing as a separate return. So what does qualify as an expense? And what we're going to be taking a look at is for both these credits, it's going to be tuition, and it could be certain related educational expenses. So things might be books, technology fees, any required fees for enrollment or attendance. Big things that do not qualify are going to be our room and board. Room and board are considered personal living expenses because you are literally living at a dorm. It's rent, it's food. You need those things in order to live anyway. So the government's not going to give you a credit based on those expenses. Likewise, any other personal type expenses or family expenses, insurance while you're at school doesn't count. Travel back and forth to school doesn't count, even if you need to take a bus, an Uber, a plane, a train, whatever the case may be. School clothing doesn't count. So the first day when you go to college, you head to the bookstore and you load up with all kinds of new clothing, sweatshirts, t-shirts with the college logo on. They may look good, you fit in well at school, but they're not deductible either. So we can't take clothing, can't take any other personal expenses. The one other interesting part we have is when we take a look at when the payments count. We need to take a look at the payments made during the taxable year. So we'll look at payments made during the calendar year. So oftentimes, if you think about a college environment, spring semester for 2020 will be coming up starting in January, usually about, depending on the institution, maybe second or third week of January. However, they typically bill for their spring semester well before you set foot back on campus. So if you pay for tuition in 2019 for spring 2020 classes, that will count as a 2019 expense. So if you pay for any educational costs in the current calendar year for any courses that start in the next 3 months of the following year, they will still count in the current taxable year. So what we take a look at, if you spent $5,000 for your fall 2019 and you received a bill for $3,000 for spring of 2020, if you pay that bill here in December, you'd have $8,000 of qualifying expenses. So we'll go ahead and take a look at how that may come into play in just a second. So what we want to take a look at next is how these credits may differ from each other. And again, what we're going to take a look at is making sure that we address the qualifications of the American Opportunity Credit. You'll see some differences listed on J4 of your 4012. The American Opportunity Credit, the most powerful of the two, and for a variety of reasons. One is you only need $4,000 of qualifying education costs in order for the credit to be maximized. And when we mean maximized, you can actually get $2,500 of credit based on $4,000 of expenses. So a fairly high payout. What we're taking a look at here, the qualifications for the American Opportunity Credit. It's permitted for the first 4 years of post-secondary education. So once you achieve your first 4 years of post-secondary education and you've taken the credit in those 4 years, you have to stop. I just want to caution, now I've unfortunately seen this in the past where when you think of a college experience, typically students will be there for 5 calendar years. Maybe not for the entire year, but for part of 5 years. Only the first 4 years, if you're claiming the credit, can be used for the American Opportunity Credit. That 5th year when they're a senior, hopefully you paid your tuition in December of that year. But if they're sticking around for a few more semesters, you cannot take that American Opportunity Credit for the 5th year. Our 8863 will walk you through the prompts to make you ask the questions for a taxpayer to make sure that they are not hitting that past the 4th year. It may help if you talk to them and say, my child is enjoying college so much, they're in their 9th year and they're expected to graduate soon, hopefully. Then you have to ask, have you taken the American Opportunity Credit for any of the prior 4 years? If so, we'll move on to the next one. So we just have to watch to make sure it's only the first 4 years of post-secondary education. Now, when we take a look at the expenses, it's going to include tuition. It's also going to include any course materials that are required for education. That includes books, any supplies, lab fees, any other type of material that may be required. And it doesn't really matter where you purchase these from. So as much as we would encourage people to buy them from the bookstore because the universities and colleges make a little bit of profit off of that, you can buy these anywhere and still qualify for education expenses for the American Opportunity Credit. Also, the nice benefit of American Opportunity, up to 40% of the credit is refundable. So if we take a look at that full $2,500 worth of expenses, $1,000 can come back to you even if you do not have any tax liability after the non-refundable part. So part of the American Opportunity Credit becomes a refundable credit. So if you've used all your, limited all your tax liability with non-refundable credits, you don't have enough taxable income, you can still get $1,000 back. A couple things we have to take a look at, a couple more qualifications. You have to be enrolled in a program for at least half time. And that may vary based on institution of what they define as half time. But the nice part about a Form 1098-T, and I'm actually going to direct you to the J6 of your 4012, which will go through what an example of a 1098-T would look like. There's actually a checkbox at the very bottom, box 8, that's going to be a check mark for whether or not the student is a half-time student. As long as that box is checked, that will allow us to go ahead and complete the rest of the American Opportunity Credit. So we do need to have a copy of the 1098-T in order to get some additional information. Also, I will warn you, this is probably one of the most odd questions you need to ask of a taxpayer in the session. If they're going for the American Opportunity Credit, you have to ask, was the student convicted of a felony for drugs? Any other felony is fine. So you don't have to get in a whole list of what I've done in the legal system. So if you say, well, is racketeering a drug conviction? No, it's not. Murder, extortion, terrorism are all fine. You can do any of those felonies and still be able to get a college credit. But possession or distribution of a controlled substance as a felony is not permissible. So that would disqualify you from the program for the American Opportunity Credit. Now, fortunately, all hope is not lost. There is another credit available for you, just not quite as powerful as American Opportunity Credit. It is odd. We do have to ask the question. Hopefully they don't ask, so could you help define what a felony is for me? No, we can't. That's hopefully something the attorney has expressed to them. If they have a question about it, they should probably contact, maybe take a Google search of their criminal history and find out what they've been convicted of. And again, it's only conviction. If you've been charged but not convicted, you're fine. That's not a problem. We had a question at the earlier session, what happens if you get a pardon from the governor or president? Unfortunately, that does not overturn your conviction. It just simply commutes your sentence. So technically, you would still be considered a drug felon. You would have to have the record expunged. But those are some issues we have to address. The other credit, if you happen to not meet the other qualifications, or if you have a felony drug conviction that you have been convicted of, you can qualify for what we call the lifetime learning credit. Now, this credit is not quite as powerful, but it still can be beneficial. So what we're looking at here is you get a 20% credit of all your qualifying expenses on your first $10,000. So you can get up to a $2,000 credit. The nice part about the lifetime learning is we take off then any of those 4-year requirements. So if someone's in school for a longer period of time, if they're going back for graduate work, if they're working on that 9-year bachelor's program, these count after the first 4 years. They also don't have a half-time student requirement. There's no other requirement. If you have a taxpayer who said, I've always wanted to study astronomy, so I'm going to go take a course at a local college, this can count. It does not have to lead to a degree or certification program. So we can take a look at any opportunities coming in for additional college costs, can qualify for the lifetime learning credit. Now, in this case, what happens is our tuition is still deductible, but only the required materials, the books, the supplies, any of those fees count if they're paid to the institution. So if the institution has you buy the books, has you pay for the lab fees, buy the material directly from the bookstore or the institution, then those can be counted as well. Again, as we mentioned, no requirement for half-time, and all felons are welcome to apply for this credit, no restriction. When we talk about payment, what we're looking at is payments that are made. They can be cash, they can be check, they can be student loans. These are all qualifying payments for purposes of education credit. If someone is willing to help pay your college funds for you, if you have a relative that says, I'd like to help out and pay some money toward college, their payments will count as being made by the taxpayer. So you can actually count their contributions as part of your monies for the credit purpose itself. One thing I do want to kind of just mention to you on the J6, at the very bottom, we kind of talk a little bit about how the application of scholarships and credits may come into play. In this case, if they actually filled out the 1098, what you would see is the institution would indicate in box 1 how much the institution's received for qualified payments. For the example we're going to run here, they would have $7,000 in box 1. In talking to the client, they've also indicated that they have paid another $500 for books. So if we're going for the American Opportunity Credit, we can add the $7,000 and the $500 together as potential $7,500 qualifying expenses. Now in box 5, they had received a grant of $3,000, so they received a Pell Grant. The $3,000 Pell Grant will be used to offset the qualifying expenses, because even though the tuition had billed $7,000, the taxpayers did not pay the $3,000 that came by way of grant. Same thing with scholarships. So we need to reduce the amount of qualifying expenses by any grants or scholarships that are not taxable. So in this case, we'd have $7,500 of qualifying expenses, $3,000 of grants that will have to reduce that amount. But fortunately, we're still left with $4,500 of expenses, which would allow us to take the American Opportunity Credit in full. Just some other things to watch for there. Obviously, the scholarship or credit will have to reduce any qualifying expenses. And it may be beneficial, particularly if the taxpayer is a little close in terms of maximizing their credit, that we may ask for a copy of their bursar or registration statement from the registrar, which will show any of the payments that they made to their account. So even though the institution may indicate that they received monies, we just want to make sure that they're not for other things that don't qualify. So if you see payments made on behalf of their dining plan, or they had parking fees or parking fines in their expenses, those don't qualify. So it's a good practice. It may be good, particularly if they're close, to say, do you happen to have a copy of your bursar statement that we can take a look at, which will show all of the income, all of the payments made and all of the amounts billed for college tuition. So that would help us identify where we're at. If they attend an institution that charges $60,000 a year for tuition and they got a $5,000 scholarship, I think it's safe to say that the $55,000 is probably a good number to stick with, that they're well over the $4,000. We probably don't need to pursue much further. Again, we're going to be working with the taxpayer in their word on how much they paid. We do want to remind them the substantiation requirements are going to be on the taxpayer. This is a credit that the government has come back on because it's relatively easy to get information to say, let me figure out my local college. I can figure out their address because I'm very good at using Google, and I don't know their identification number, but if I call them up and say, I'm trying to complete my income tax return, I'd like your identification number, they will freely give it to you over the phone. So the government is trying to crack down and make sure that we actually have qualifying individuals to take the credit. So they don't want to give out any more money than what they've done in the past for people who are actually not in college. So Form 1098-T would be helpful, and potentially also taking a look at some additional material like the registration statement or bursar statement would be helpful. One other credit that we do want to talk about is the Retirement Savers Credit. And this is an opportunity for individuals who are putting money away into a retirement plan to take an additional credit on their income tax return. This is found on G14 of your 4012 with a little bit more information. And this is allowing individuals, if they make a contribution either to a traditional IRA, which we would know because we're actually entering that information in on the adjustment section. It also counts if they make a Roth IRA contribution, which we'd find if they bring in a Form 5498. This would count for any elective deferrals to a 401k or 403b plan. Also, if they participate in a 457, a government plan, a SEP or simple. And you may ask, well, how do I know if they're participating in a plan? Well, the IRA, we'd be entering the information, or they have a 5498 coming in as well for either a traditional or Roth. And we can also find this out because the system will automatically start calculating this for us. So if we enter the W-2 in a tax layer and we take a look at those codes in box 12, if you enter any of the following, a D, an E, an F, a G, an H, an S, a double A, or a double B, feels like I'm calling bingo numbers out here, that will automatically populate and calculate a retirement savers credit. So if the taxpayer's AGI is eligible, it will automatically calculate the 8880. There's not much else we need to do to calculate this credit. Now, that's a good thing because it doesn't require much work on our part. It's a bad thing because there's technically one more question that we need to ask before the taxpayer is eligible for the retirement savers credit. They cannot be a dependent or full-time student, which is generally indicated within our intake sheet. So when we go through the process, we check certain criteria, we'll make sure that they're not a dependent or a full-time student. There's also a situation where they have to be born before January 2nd, 2002. So this is kind of an odd little departure. Most times the IRS is going to use traditionally the end of the year as a measure, right? The child has to be under the age of 18 by the end of the year, or the child has not, we'll take a look at your marital status at December 31st. This is giving a benefit to January 1st babies. So if you were born on New Year's Day, you get a special break. Apparently the IRS is taking pity on you because your birthday's shared, mainly you're having pork and sauerkraut every birthday meal, especially if you're here from Central PA. And perhaps, you know, your parents made a tough decision the night you were born in the delivery room, and the doctor is looking at the mother giving birth and saying, okay, it's 10 minutes to midnight. We have two choices here. You can be the very last baby born in the hospital in this year, or we can hold you off a little bit, and then you'll be the first baby born for the New Year's Day. And if you're the first baby born, you'll get your picture in the paper. You'll get all kinds of news recognition. Someone will give you a very nice gift basket. You'll get all kinds of wonderful things. They'll give you free diapers. They'll give you free formula. And you'll get a lot of publicity and say, let's go for option 2. I think I can hold out 10 more minutes. Without realizing that potentially down the road, this may impact my child when they go ahead and try and get the Retire Savers credit. Well, the government stepped in and said, hey, we understand. We'll go ahead and give a benefit for those New Year's Day babies. So if you're born on January 1st, before 2002, you're good. So January 1st, 2002, you're good to go. Again, the system will calculate that automatically. It's this very last section that we need to take a look at and determine whether or not we have any issues. So if a taxpayer has taken a retirement distribution, so if they've taken money out of their retirement account in 2017 or 2018, the amount that they've taken out of that account is going to reduce the amount eligible for the retirement savers contribution. So unfortunately for TaxSlayer, they will automatically default to assume that there was no distribution made in those 2 years. If you see the taxpayer getting an 8880, it may be beneficial for you to either take a look at the prior year return or at least ask the question, did you have a distribution from your retirement account in 2017 or 2018? That can impact the amount of actual credit. At this point, we really don't have much of a solution other than taking a look at the 8880 and entering that information in manually. It will not pick it up from the prior year, but you have to ask the question to see if they're fully eligible. The fortunate part, most people, if they qualify, won't have a clue when you ask them if they had a distribution from a retirement account. Again, that's a great answer, meaning that they probably did not have a retirement distribution. So we can kind of work with that. All right, so we're now here at kind of our second section. So we have done what is a great opportunity. We've done some adjustments. We've talked about some really good things called non-refundable credits, and we'll be moving into a refundable credit, but I think we'll keep moving on. We're good. All right. Do you want to sell some more shirts? Are we? Okay, all right. Okay. So what we're going to be talking about next is kind of our best situation. One of the most exciting parts about VITA. And when we do apologize, because the first 2.5 sessions, we probably have scared you, thinking, oh my gosh, I need to make determinations about filing status. So I need to understand dependency. We went through all these items of income. It sounds like people may not be happy with me when I talk about a code 1, early distribution of a retirement plan. I may pay more taxes than what I thought. Well, these are the areas that we really see the benefit out of VITA. And one of the main reasons why people want to come in to get their taxes prepared by someone else, because we have these refundable credits. And the refundable credits allow individuals to go ahead and get a tax refund even if they don't owe any taxes. So this is money that can come back to them even if they've already gotten all their withholding back, even if they've gone ahead and eliminated all their tax liability, they can still get additional dollars. And we're going to be talking about a couple things here. We're going to be talking about the child tax credit and credit for other dependents. We'll talk about the earned income credit. And also the one thing we have to watch, if an individual has made estimated tax payments, it doesn't happen all that often, but every once in a while we do have people who like to try and pay money into the government. if they either have an estimated tax payment or they had a prior year refund, but they elected to apply that refund to the next year. We would just need to enter that information, which would then show up again on our 1040 Schedule 3. That would be on line 8. But now to the fun part, talking about our credits. The first one we're going to talk about is the child tax credit, which is going to be found on G2. Now, this is a credit that has been expanded. This is the second year that this has actually been increased. A couple things have changed on it. The credit has increased in amount. It's $2,000, same as it was last year. The AGI phase out has also dramatically increased. So one of the things we've seen is generally in the past, a lot of our middle class taxpayers never qualified for this. They bumped up the AGI limitation to $400,000 now for married filing jointly. So it's a much bigger change. Now, what has kind of the basic criteria we have here is this credit is $2,000 per qualifying child, and up to $1,400 on that credit can be refundable based on certain criteria. This is going to be like those who enjoy sausage. I'm going to show you how it's made, but you don't need to worry about it any other time other than this point in time. We'll tell you how that refundable credit is calculated, but you never have to do it. The system's automatically going to go ahead and do the credit calculation for you. There are some eligibility rules. So we're starting with the definition of child, which we've already heard about. Dependency means that they're under the age of 19 or under 24 and a full-time student. Then we heard the IRS change it slightly to say, well, a child for child and dependent care credit is a child under the age of 13. Now for the purposes of the child tax credit, now they have to be a child under the age of 17. So somewhere the IRS has made a determination that children can still be dependents under the age of 19. So 18 and under, they still need their parents. However, they can take care of themselves at the age of 13, and somehow they don't really cost that much once they hit age 17. So after they get their license, they want to have the freedom to go around and do other things, pay for cars, pay for clothing, go out to eat. They don't cost as much money as a 16-year-old. So you need much more credit when you're 16 years old, apparently. But the rule here is once you turn 17, that child is no longer eligible for the child tax credit. So if you take a look and someone says, I've always gotten a much bigger refund than what I have this year, what did you do? Hopefully they're not going to ask you that. That's not how it comes across. But they may say, why is my refund different from last year? And one of the reasons may be because if they had a child who turned 17 throughout the year, they're no longer eligible for a $2,000 tax credit. Now we'll show again another opportunity here for them, but they might be losing out on a relatively large credit, part of which could have been refundable. Now, in addition to the child being under the age of 17, and another caution there is if you see a child who is 16 that's coming in, a child has a dependent at 16 and eligible for the credit, you may just want to make a quick note to the taxpayer to say, just to remind you next year that your son or daughter is turning 17 and is no longer eligible for the $2,000 credit. So you may just want to give them some fair warning to say next year they will not be eligible for the full child credit. The child has to be a U.S. citizen, a U.S. national, or a resident alien. The child has to be claimed as a dependent on the taxpayer's return. So when we take a look at this situation, if you have a dependency exemption, you also get the child tax credit. The custodial parent is eligible to take the dependent care credit or child care credit and the earned income credit, even if they don't have the child as a dependent on their return. It's only a unique situation for non-custodial and custodial parents. But the non-custodial parent, whoever's taking the child as a dependent on the return, will automatically get the child tax credit. The child has to have a social security number by the due date of the return. If they don't have one, we cannot file the return. So if there's a process where they might be going through an adoption or for some reason they were born near the end of the year, that they qualified, again, the doctor didn't convince you to go to January 1st, because if you push them up to December 31st, you get a whole year of deduction for that child and the child tax credit. But if you haven't gotten a social security number yet, we have to wait till that's actually received before we can file the return. Now, we mentioned that there are some opportunities for this to become a refundable portion. So we call this the additional child tax credit. If you have earned income over $2,500 as a taxpayer, your credit can become refundable. So again, it's taking a look at individuals who are working and will automatically convert part of that child tax credit to a refundable piece. What we're going to take a look at, I give you the kind of the calculation there if anyone would like to try some math at home between now and tax season. But we go through what it basically would look like. is you can get a refundable credit 15% of your earned income over $2,500, or the amount of the unused child tax credit. Whatever amount was non-refundable that reduced your tax liability to zero, we can get up to that amount as a refundable piece. You can also qualify if you have 3 or more children. So if you have at least 3 children, and kind of 3 is a magic number for kids. If you have 12 kids, good luck to you. You only need really 3 to maximize a lot of our deductions here, other than the child tax credit. But it becomes refundable if you have 3 or more. Now, what happens if you don't qualify for the child tax credit? So let's just say we have that situation where a child has turned 17 during the year, or you may have other dependents on your return. Well, fortunately, there is a credit available. This is a $500 credit, which is why we still teach the whole concept of taking dependents on an income tax return, because they don't really qualify for much else other than this $500 credit. So if they qualify as a dependent on your return and they don't meet the eligibility rules for a qualifying child, for the child tax credit purposes, they can actually give you a $500 non-refundable credit. So that can be used to help offset your tax liability. A little bit more information on G4 here. Again, what we have to take a look at is the dependent cannot be a qualifying child of anyone else, so they're not going to be claimed as a qualifying child for another taxpayer. They have to meet our dependency rules, meaning that they would be here for a qualifying relative. Again, that can be a whole variety of individuals. It's a very broad family tree we have there, or a child who is aged out of the under 17. The dependent has to be a U.S. citizen, U.S. resident, U.S. national for the U.S. So we changed the definition a little bit. Before, you could be a resident of Canada or Mexico and still qualify as a dependent. That does not count for the other dependent credit. So fortunately, we're here in Pennsylvania. We may not see a whole lot of situations where your family's living in Mexico or Canada. If we had an El Paso site or Buffalo, New York site, that might be a whole different story. But here, we just have to make sure that our dependents are U.S. citizens, residents, or nationals. And again, we have to make sure that each dependent is going to have a social security number, an adopted taxpayer identification number, or a temporary identification number called an ITIN. So they have to have some documentation in order for us to go ahead and take the credit. Okay, so what we've been building toward, started off with kind of a very good position. These adjustments to income, which help reduce our taxable income dollar for dollar. We kind of came at this pretty nice position of credits, kind of the better position of credits. We walked through a couple non-refundable credits, and then we got into our refundable ones. And now we're going to hit the best. This is going to be the big one. This is why people are coming into VITA. This is so big, we have an entire tab dedicated to the earned income credit. So as much as you're fearing about what tax season will look like, I like to call this one the hug credit, because if you don't mind being hugged by your client, it may happen after you give them the earned income credit. If you don't like physical contact, be sure you set the boundaries up front. We've talked about kind of our facial tissue issue when you have the code 1 for an early distribution from a retirement account. This will be one where you're going to be prepared to get hugged. And it will happen on occasion. So again, just set your boundaries in case you don't like physical contact. Just say, please no hugging. But this is a great credit. This can give individuals, particularly those that are in a VITA qualification, people with relatively lower incomes but still have earned wages or other sources of earned income, becomes a refundable tax credit. And when we take a look at these, the qualification is you have to have earned income. So earned income for purposes of VITA will traditionally be our wage income. It could be income from self-employment if you're going to go on to certification for your advanced qualifications. Or if a taxpayer has gone out on disability and they're receiving long-term disability payments, but they haven't yet reached retirement age. Those payments are considered qualification for earned income. Couple other rules. Your investment income may not exceed $3,600. Generally not too much of a problem within VITA. Based on interest income, we kind of joked about how much interest income you would need to generate $50 of interest. We're talking about like a small country's net worth in the bank to get $3,600 worth of interest for the year. So we're probably not going to see it from interest income. We may see it from dividends or other investments, but traditionally within VITA, we don't see a lot of investment income that would disqualify an individual. Probably no surprise here, the filing status we cannot use to take an earned income credit is married filing separately. So we cannot use married filing separately and still get the earned income credit. In this case, everyone on the return, the taxpayer, the spouse, and any qualifying children must all have Social Security numbers. You may not be dependent on someone else's return. And because of the popularity of this credit, the IRS will, on occasion, take a look at these returns and just make sure the individuals qualify for the earned income credit because of the significance. If an individual is found for improperly taking the earned income credit, they may be barred from taking the earned income credit either for a period of years, if it was inadvertent, or banned for life if it was done deliberately. So we just have to double check to make sure that the taxpayer was not prohibited from taking the earned income credit. Generally, not too much of an issue within VITA. If you have a qualifying child, this will really increase the amount of earned income credit opportunity for two reasons, which we'll show you in just a minute. So the qualifying child rules are going to be very, very similar to our dependency rules, with one major exception. The support test doesn't qualify anymore. So if the child has provided more than half their support and they don't meet your dependency exemption, they can still be considered a dependent for earned income credit. So if they provided more than half their support, they could be a qualifying child. Again, for the most part within VITA, they're going to stay in the same definition. We're not going to add a whole lot of people onto the EIC definition from what we have from the initial intake. They also have to live with the taxpayer for at least half the year, which again goes back to our custodial parent. So the custodial parent, even if they released a dependency exemption to a non-custodial, the custodial parent's the only one that can claim the child as a dependent for earned income credit purposes. So that may be one situation where we have to add the child back in on the return. And when we get to our session over at HAC, we can show you how to enter the dependent in to not be dependent on the return, but to qualify for earned income credit and child care purposes. So now the big reveal. Why are we doing this? Well, the following chart is going to be for the following tax filing status: single, head of household, and qualifying widow or widower. Now, the reason why we talk about a child is if you do not have a qualifying child, you have to be between the ages of 25 and 65. So if you don't have a qualifying child, if you're under 25, you're not eligible for the earned income credit. Likewise, you're not eligible if you're 65 or older. And the reason why is the government does not want to try and calculate earned income credit for individuals who may be part-time jobs. So a retiree that may be collecting Social Security and they may have some earned income, they're not going to qualify for the earned income credit. Likewise, a college student who may have some additional income over the summer or working on campus, unless they have a qualifying child, will not qualify for a earned income credit. But even so, if you don't have a child and you're between the ages of 25 and 65, if your earned income is less than $15,570, you can still get a $529 maximum refund. So what we're going to show here is the column with the income is where you can earn up to that amount of income. After that, you're no longer eligible. And the maximum credit is going to be based on a number of factors. It's actually kind of a bell curve that goes into our filing status here. So the income is going to be earned throughout. The IRS doesn't publish those numbers, mainly because they don't want anyone to exactly pinpoint what the maximum amount of EIC would be. But just to let you know, even if you don't have a child, if you have relatively low earnings, you can get $529, which if we had Jesse walk around and give everyone $529, I think we'd all be pretty happy. Or $529 in merchandise credit toward your VITA shirts. I'll buy you quite a few for ready for the season. So $529 is not a bad amount of money to walk away with. Now, what happens if we start adding children to the mix? Well, if we're single, head of household, qualifying widower, and we have one child, now the age test goes away. So if you're under 25 or if you're over 65 and you have a qualifying child, now the age test doesn't matter. Now you're eligible for the earned income credit again. And now what happened is your wage base has moved from $15,570 up to $41,000. So that has just incredibly expanded the reach of the earned income credit. Not only that, but your credit has moved from $529 up to a maximum of almost $3,000 more, $3,526. If you add another child, that goes up to $46,703 of maximum earnings, and then a credit of another $2,300 up to $5,800. If you add three or more, then you're up to $50,000 of earned income, and the credit's a little over $6,500. And you may ask, what happens if we keep adding more kids? This is great. Well, nothing happens. Three's our max. That's as far as we go. So we can't go any further than that. Now, the next chart would be, again, for reference purposes only, the system's going to calculate all these. So this chart's going to be for married filing joint return. So if you're filing jointly with your spouse, again, if you don't have any qualifying children, you need to be between the ages of 25 and 65. The earned income's gone up quite a bit to 21,370. That's going to be based on the combined amounts. Again, the credits will stay exactly the same for the maximum. If you add children now into the equation, this goes up a whole lot higher. You can see that if you add one child, a married filing jointly couple can go ahead and earn up to $46,884 and still be eligible for the earned income credit. Again, these are going to be $3,500 worth of credits. If we add another child, it's up to almost $52,500. If we add the third child, it's almost up to $56,000. So we're almost right up against our limits for VITA qualification for married filing jointly. Again, you don't need to memorize these tables. These are actually going to be all contained within the system, but it just wants to illustrate the benefit of how these programs can work. So these will be automatically calculating for the earned income credit. And this is why when you go through the calculation piece and you start entering income, and then all of a sudden that button starts calculating, and all of a sudden that green button comes up the bottom and says, here's your refund, be prepared for a hug potentially. Unless you have a non-hugger as your client, then they may not want to hug. But this is where we're going to get a lot of money back for the community. So when you get to hear the numbers at the end of the year, how much we've been able to bring back to the region is generally coming out of the earned income credit, essentially helping working class families be able to provide more money back in their pocket. So this can help go for things like more affordable housing, reliable transportation, but it really provides a great benefit to our clients here at VITA and allows them to have a much higher refund. One of the reasons they like to come to us is because we actually know how to calculate it. And when I say we, it's basically we put the information in, TaxSlayer will calculate it for us. No calculations by hand. So fortunately, we don't need to worry about hand calculations. We're all computerized, and you'll thank us as to why we don't have to do these by hand when you see the earned income credit tables of how that would work. So it becomes a much, much easier process. All right, so the earned income credit, one of the most powerful things, and I was going to end on that, although I have 2 more slides for you. So we're talking about kind of basic certification with our first 4 trainings. The 5th one will be those of you who are interested in going for an advanced certification. But there's one other certification that you can actually achieve, even if you decide not to go for advanced certification. That's for the health savings account certification. Relatively quick, easy test. This is going to be a lot more common that we see within taxpayers now. A lot more of employers are moving to what we call a high deductible health plan. So instead of a traditional health plan where you have a relatively low deductible but high premiums, this gives individuals an option to pick a plan that may have a relatively low monthly cost but a much higher deductible, so that your out-of-pocket monthly costs for insurance are relatively low. However, if you need medical care, it's going to cost you more out-of-pocket. These are going to be determined by the employer. So usually most people will know if they have a high deductible plan. There are some limitations in place. But generally they'll know that they have a health savings account. A little bit more information on E6 of your 4012. The nice part about a health savings account, if you have a high deductible plan, you're eligible to create a savings account for you and your family to offset those higher costs. Now, generally what will happen with these plans is that these will be available through your employer. So the employer may decide to add some money to your account, maybe as an inducement for you to pick a lower cost health plan. You can also participate by providing your own contributions to the plan on a pre-tax basis. So these are actually going to be reducing your taxable income. These are going to be indicated on the W-2 box 12. So if you take a look at W-2 box 12, it's going to be a code W for employer contributions. So that would include any contributions made by the employer or any contributions made by the employee on a pre-tax basis. If the employee has made any after-tax contributions, which doesn't often happen, but sometimes can, or if they have a family member who says, well, you don't have any kids in college, so I'd like to help you out in another way by putting money into your health savings account. Any after-tax contributions can also be a tax deduction for you. So that'll actually create a tax adjustment as well. If you have any of these contributions, and you may see this because you're going to be getting a 5498 SA, which would report the amount of contributions, we can actually take a deduction for it. In all cases, we're going to be filling out a form 8889, which will show the amount of contributions and deductions. Now, on the other side, when you get to take a health savings account, you can put the monies aside tax-free. These funds will grow and become completely tax-free if the proceeds are used for qualifying medical expenses. So as long as you use these for qualifying medical costs, you never have to pay tax on them. And quite often, the system's set up in a way where you will actually get a debit card from your HSA provider that can only be used for medical costs. So you can't take it down to the local gas station and fill up your tank and get some beef jerky. It can only be used for doctors, dentists, ophthalmologists, optometrists, or other types of expenses. So in most cases, the HSAs are all going to be qualifying medical expenses. We just need to verify that with the taxpayer. So often they will get a Form 1099 SA. So the 1099 is showing a distribution, the SA for savings account, and the clever IRS naming recognition tool, so we know what it is. If that HSA distribution has been used for qualifying medical expenses for the taxpayer, the spouse, or dependents, it will be completely tax-free. If they roll the HSA proceeds from one provider to another, which sometimes may happen if you leave an employer, they may have an HSA provider that has provided the plans, but you may choose to move that to your own account. Again, these are portable. The HSA is a fund that you get to keep for the rest of your life. So as long as you have funds in the plan, you can use those for qualifying medical costs. Those will not be taxable at all. Now, if for some reason you took the money out and you did not have qualifying medical costs, again, it's a little bit harder to do, that income will be subject to taxation. So that'll be a non-qualifying distribution and be subject to tax. If you recall, last week we talked about the 1099-R, Code 1, Box 7, a 10% penalty, and that sounded pretty harsh, right? This one's a 20% penalty for taking money out of an HSA for non-medical purposes. So this is not to be used as a savings account in general. There's an H in front of this for a health savings account. So if you take $1,000 out of the plan because you thought it'd be a nice way to tap $1,000, that's $1,000 of taxable income, and the government's automatically going to get $200 of that. So we don't encourage any withdrawal from an HSA prematurely. Now, however, there are some exceptions to the penalty. If you're deceased, which we probably won't see you at tax time, that is an eligible distribution. It's not going to be subject to penalty, but it will still be subject to tax. If you're disabled, you can take the money out as well, not subject to penalty. It will be subject to tax, or if you reach age 65. So you may hear some people talk about an HSA as quasi-IRA, because it kind of has that same property. If you wait until you retire and you withdraw the money, it's going to have the exact same qualifications. It's going to be taxable income to you. However, we probably recommend that you want to keep the HSA intact because it can be used for any type of qualifying medical costs. Once you reach age 65, you can no longer contribute to an HSA, but you can use that in perpetuity. You can use that to pay for your Medicare supplemental insurance. You can use that to pay for eye doctors. You can use it to pay for dentists, any other over-the-counter or prescription medication that qualify for these programs can be used with an HSA. So we don't really have to go into a whole lot of detail about the HSA program itself, but if you want the certification, this will allow you to prepare returns if you get a 5498 SA, if you get a 1099 SA, or if there's a code W in box 12 of the W2.